Right now, as we speak, Bank of America Corporation, trading under the ticker BAC on the New York Stock Exchange, is hovering at exactly $54.11 per share. We are seeing a modest intraday push, up approximately 21 cents or 0.39% from the opening bell. The market is currently open, and the price action we are witnessing today is deceptively calm. If you look at the chart, you might see a flat line or a gentle drift upwards, but do not let that fool you. This low volatility is the calm before the storm. The volume is lighter than usual, clocking in around 14 million shares so far because the entire financial world is sitting on its hands, holding its breath for the Federal Reserve's interest rate decision scheduled for tomorrow. But while the average investor is obsessing over whether the Fed will cut by 25 basis points or hold steady, something far more significant is happening beneath the surface of Bank of America's massive institutional machinery. Most people look at Bank of America and see a legacy institution, a place where you park your checking account or get a mortgage. The expectation is that this is a slow-moving, interest rate-sensitive giant that moves in lockstep with the Federal Reserve. That is the expectation. The reality, however, is that Bank of America has quietly begun a strategic pivot that fundamentally alters its growth thesis for late 2025 and moving into 2026. While the headlines are focused on the Fed meeting tomorrow, the real story, the one that isn't getting enough airtime, is the bank's aggressive formal entry into digital asset advising. Just days ago, reports surfaced that Bank of America is now allowing its wealth advisors to recommend a 1 to 4% portfolio allocation to crypto assets for eligible clients. This is a massive departure from the conservative, risk-averse reputation the bank has cultivated for decades. It is a direct challenge to the fintech disruptors who thought they owned that space. So while the street worries about a quarter-point rate move, BAC is effectively engaging in a land grab for the next generation of wealth management, signaling that the divide between traditional finance and digital finance is officially dead. To understand why this stock is trading at $54.11 today, near its 52-week highs, we have to look at the immediate market context. We are late in the year, December 9, 2025. The Santa Claus rally narrative is being pushed by every pundit on television, but the institutional flows tell a more nuanced story. Today's price action in BAC isn't driven by retail euphoria. It is driven by institutional positioning. Fund managers are rotating. They are moving out of high-beta speculative tech plays that have run too hot, and they are parking capital in high-quality financials that have, quote, caught up to the digital age. Bank of America is the beneficiary of this rotation. The stock is up roughly 23% year-to-date, significantly outpacing the broader financial sector. Why? Because the market is finally rewarding them for what they actually are: a technology company with a banking license. Let's talk about the intraday movement we are seeing right now. The stock opened at $53.97, dipped briefly to $53.65 in the first 30 minutes of trading as weak hands folded ahead of the Fed news, and then ground its way back up to this $54.11 level. This V-shaped recovery on the intraday chart is bullish. It shows that every time the stock dips below $54, there is a programmed buyer, likely an algorithm or a buyback desk, stepping in to scoop up shares. This support level is critical. If you're watching the order book, you will see a stack of buy orders sitting right at $53.80. This tells us that the downside risk, at least for today, is capped. The market does not want to sell this stock. It wants to own it, but it wants to own it at the right price before the Fed chair steps up to the podium tomorrow. But we need to zoom out to understand the tension here. The common belief, the expectation I mentioned earlier, is that Bank of America is still carrying the heavy baggage of its bond portfolio. You might remember the panic back in 2023 and 2024 about unrealized losses. The narrative was that BAC had bought too many treasury bonds when rates were low, and as rates rose, the value of those bonds crashed, leaving a hole in their balance sheet. That narrative is stale. It is outdated. The reality is that those bonds are maturing. Every single day, low-yielding bonds roll off the books and are replaced by new assets yielding 4, 5, or 6%. This is the burn-down effect, and it is accelerating. The net interest income, the profit they make on loans minus what they pay on deposits, is expanding again. In their most recent Q3 earnings report, which we saw a few weeks ago, they posted a revenue of $28.1 billion and an EPS of $1.06, beating the consensus estimate of roughly 95 cents. That is not a bank in trouble. That is a bank firing on all cylinders. This brings us to the competitive landscape, which is where the real battle for the future of your money is being fought. You cannot talk about Bank of America without talking about the ecosystem wars. On one side, you have the disruptors, Robinhood stock trading, the Robinhood app, SoFi Invest and their robo-advisors. On the other side, you have the legacy giants fighting back, Fidelity Investments, Schwab Intelligent Portfolios, and Interactive Brokers. For a long time, the narrative was that the young, smart money was leaving traditional banks for the slick interfaces of a Robinhood app or the automated ease of SoFi investing. And for a while that was true. The user experience on those platforms was light years ahead. But Bank of America didn't sit still. They poured billions into technology. Look at how they have integrated Merrill Edge. It is no longer a clunky add-on. It is a seamless part of the banking experience. When you log in to check your checking account, you are one click away from your investment. This integration is the killer app that the fintechs cannot replicate easily. Robinhood investments are great, but can you walk into a branch and get a notarized document or talk to a wealth specialist about a complex trust? No. Bank of America is leveraging its physical footprint to reinforce its digital dominance. They are capturing the hybrid investor, the person who wants to trade Tesla stock or Nvidia stock on their phone during their lunch break, but also wants a human being to talk to when they're planning their estate. This is why you see Fidelity and Schwab fighting so hard with their own versions of hybrid models, like Fidelity Wealth Management or the Schwab Intelligent Portfolios. They know that the pure-play online investing model is evolving into a relationship-based model, and BAC is already there. Speaking of online investing, let's discuss the user behavior shifts we are seeing in late 2025. The era of meme stock mania has matured into something more sustainable: informed self-investing. Investors are using tools like Interactive Brokers for their low fees and professional-grade charts, or Fidelity ETFs for long-term compounding. But Bank of America's ace in the hole is their data. They see where you spend every dollar. They know if you're subscribing to ChatGPT or buying groceries at Whole Foods. They're using this data to hyper-target financial advice. This is the intelligent portfolio concept taken to the next level. Not just balancing stocks and bonds, but balancing your entire financial life. This is why the stock is commanding a premium today. Investors are realizing that BAC is not just a bank, it is a data powerhouse that rivals any tech firm. Now, I want you to pause for a second and think about your own portfolio. We often talk about these institutions as abstract entities, but they hold our actual wealth. Comment below how many shares of Bank of America you currently hold, or if you're staying away from banks entirely. Tell me why. Are you team traditional finance, or are you all in on decentralized alternatives? I want to see the debate in the comments section. Let's dive deeper into the recent crypto news because it is critical to the reality portion of our analysis. For years, Jamie Dimon at JP Morgan and Brian Moynihan at Bank of America were hesitant, bordering on hostile toward crypto. They called it speculative, they called it dangerous, but the reality of client demand has forced their hand. By allowing advisors to recommend a 1 to 4% portfolio allocation to crypto assets, Bank of America is essentially legitimizing the asset class for the mass affluent demographic. This is not about day trading Dogecoin. This is about structural adoption. It means billions of dollars of sticky money, retirement money, trust fund money could actively flow into digital assets through the Bank of America pipe. This generates fees. It generates engagement. And most importantly, it stops the bleeding of assets to crypto-native platforms like Coinbase or the crypto arm of Robinhood. It is a defensive move that has turned into an offensive growth catalyst. We also have to discuss the macroeconomic backdrop that is pushing BAC to $54.11 today. The Federal Reserve, under Jerome Powell, has been navigating a soft landing. The consensus for tomorrow's meeting is a 25 basis point cut. Why does this matter for Bank of America? Banks usually profit when rates are high because they can charge more for loans, so you might think a rate cut is bad for BAC. But that's a surface-level analysis. A rate cut is actually bullish for BAC right now for two reasons. First, it lowers the cost of their deposits. They have to pay you less on your savings account, which widens their profit margin instantly. Second, and more importantly, lower rates stimulate loan demand. The mortgage market has been frozen for 2 years. A rate cut thaws that ice. It gets businesses borrowing again. It gets the M&A, mergers and acquisitions market moving again. Bank of America is a top-tier investment bank. When companies start buying other companies again, BAC earns massive